are here on the
right.
show.
Excellent, excellent.
Crazy week, man. We've been traveling. Let me turn that up a little bit so we can hear each other.
Good.
I like that better.
Yep, better.
Yeah, Jerry and I did a little road trip this week and went down and checked a few things out down in South Carolina. It was nice.
It was nice.
Nice to get away, but we spent way too much time in a vehicle.
Way too long.
Yeah.
We picked quite a week to go to basically be out of the office. The market, of course, always goes sideways whenever I'm out of town.
I'm driving. Jerry's just staring at his phone.
Yeah, it was a pretty emotionally charged week on Facebook. If you looked at the groups and some of the emails and stuff, I mean, we had the prior 2 weeks, both weeks were down. And then we closed last Friday basically right on the 50-day moving average. And then we had almost a 2% drop on Monday. And by then, people were kind of starting to freak out. And you could definitely see a lot of fear-based comments, right?
Yeah.
And then Tuesday was more or less flat. It was down a little bit, more or less flat. Then Wednesday, Thursday, Friday, market comes running back up. And everybody, I mean, the greed is back on. Everybody's back in and ready to go.
Isn't it amazing how that works, though?
Yeah.
I mean, in such a short time span, too. We talk about it, ad nauseum sometimes, where it's like you can't, not with the TSP. You can't live in this world of like watching it go up and down and like thinking that everything is better all of a sudden when it's green and oh my God, it sucks when it's red. And we're not day trading, and you can't let it like bring you in that emotional cycle. That's
actually what the whole newsletter is going to be about.
Good.
This weekend, that exact concept, that whole thing. But yeah, if fear and greed is dictating your reallocation decisions, you're probably missing out on both ends.
Absolutely. Yeah. I mean, you can't let fear and greed be involved. Emotional trading is never a good idea. I don't care whether it's the TSP or not.
Right.
Emotional trading is a horrible idea.
Yeah, it could be timeshares, it could be real estate, it could be
anything.
Anything.
Yeah, when you're dealing with finances, emotions can't be involved. I mean, they creep in there, right? Because it's stressful.
It's a natural reaction, and the vast majority of people. And now I feel like I'm quoting what's going to be in the newsletter, but the vast majority of people
give them a little peek.
That's how the brain wants to treat these things, right? So unless you're really grounded in some kind of analysis, it can be fundamental analysis, it can be technical analysis, or you could be buy and hold, and then I just wouldn't pay attention to any of it.
Yeah, honestly, that's what really kind of blows my mind is all of these folks that we know kind of tell us they're buy and hold. I'm always in CNS. I'm always C. Yeah. Then why are you even watching it?
Yeah, right.
Like, why are you even paying attention?
Especially when it's going down. I'd be hiding from it.
The whole point of buy and hold is set it and forget it. Then forget it. Why are you even talking about it?
Right.
You're stressing yourself out for absolutely no reason.
Because what we know happens, because you can see it in the chart, what happens is once, this is not everybody, so I'm sure people are going to yell at me on Facebook about this, but the reason so say 50% retracement level. The reason that works, 50% isn't a Fibonacci number. The reason the 50% reallocation level works is because the majority of people, when you see your account has dwindled by half, you say, screw it, you throw the towel in, I'm out. And that, a lot of times, is the bottom.
Right.
That's kind of what happens. It's human nature is what this. It's fear and greed. I mean, I don't. We talk about it all the time. I don't know how else to say it. It's a chart.
It's a chart
simple. Of fear and greed.
It's pretty simple. Well, let's jump into the show, man.
Yeah. Okay. All right. Weekly update show 26 September 2021. Almost done with September. We got a few interesting things to talk about here. Okay. So it was a mixed week for the market. It was very volatile. It was kind of a roller coaster week. At the end of the day, the C fund was up about 0.5 point. S fund also up about half a point, 0.5%. I fund was down 0.25%, and the F fund, which is going to be our bonus chart, actually was down 0.4%, which is a lot for the F fund. And the pattern is really interesting on the F fund right now. So we're going to look at Elliott wave, big picture. We did a much longer term big picture last week. We're going to look at one of those charts again for a little bit refresher of that perspective. And then the Fibonacci retracement levels of where, if we are still in a correction, where we want to see price come down to find support before it moves higher. And then a couple weeks ago, we had done this thing, the S&P 500 composite, cycle composite chart. We got a little bit different one to look at this week, and it may give us some indication of when, in terms of timing, maybe this correction would end and what the remainder of the year historically would look like. And then, like we said, F fund is the bonus chart, and then we'll look at the 20-month weekly charts. All right. So the big picture Elliott wave count, this link, if you're looking for a link to basically cliff notes of Elliott wave and Fibonacci's and everything else that's associated with Elliott wave, this is a great website to take a look at. It's got all the rules, the guidelines, the impulse waves, corrective wave patterns, and it's all in one place. So definitely take a look at that link. We put this chart up last week, and I just wanted to kind of go over it. I didn't update it for this week because it's a long-term chart, and the 1 week added to it really doesn't make that much of a difference. In the big scheme of things, so this is the relatively long-term perspective for us. We got a bottom here from COVID. So now we're trying to figure out where the top is, because once that 5 is in, we got some significant downside that's coming, but we're not there yet, so we're not going to talk about it yet. So there were some, last week we talked about basically 4 observations off of this chart. So we talked about this thing last week called the guideline of alternation. So we came up to a 1 leg here, and then we had a sideways ABC for a 2. Since this move is sideways, alternation would imply that the wave 4 is deeper and faster. So this one was kind of long and flat. This one should be kind of deeper and shorter. It's a guideline, it's not a rule, so it doesn't necessarily happen that way. And it also presupposes that we are already at the top of the 3. We don't know that we're at the top of the 3. If the market makes new highs next week, then this is not the 3. And it just keeps going. Eventually, we do get a 4 and a 5, but we will adjust the chart as we keep moving forward. Okay. If we do have a 3, right here, wave 1, according to the rules, this is not a guideline, this is a rule. Wave 3 cannot be the shortest wave. So if wave 3 can't be the shortest wave, then we go back to wave 1, which started down here at 2200 and finished up here at 3600. That's 1400 points. From the bottom of wave 2 at 3200, we would need to get up to 4600 to equal the length of wave 1. And we didn't get there yet. So right now, wave 3 is shorter than wave 1. If that's the case, then wave 5 has to be shorter than wave 3. So wave 5 is limited to how high it can go to somewhere under 1400 points. So it would actually be a bullish thing if this dip that we had continues higher for the next couple of months or whatever, and then we get a wave 4 down. Because if we can get above 4600, then get a 4 leg, then the 5 leg can be, can go off and go much higher if that's what happens. And again, this is a kind of a Elliott wave rule. So the other rule that we're kind of looking at in this chart is that wave 4 can't go into the price territory of wave 1. So that puts a downside limit to wave 4. So wave 4 can't go below the top of wave 1, which is 3,600. If we, if this correction brought us down to 3,600, people would be very freaked out. But theoretically, if we're in this 5-wave move, then wave 4 can't go lower than wave 1. So again, if the 3 is in place right here, then we get some kind of wave 4 down, and then we should expect somewhere under a 1,400 point wave 5. Okay. So what are the levels? This is interesting. IT problems, that shouldn't surprise anybody. Okay. What are the levels that we want to see or sort of expect to see if we're still in this correction? So these lines are the Fibonacci retracement levels that I took from the bottom of wave 2. So if you're using bigcharts.com, you use the Fibonacci tool, and it draws out these Fibonacci extension levels for you. So if this is wave 2, and this is the top of wave 3, a retracement down to the 23.6 should be the first support level, or down to the 38.2 would actually be a better support level. So somewhere between 42.33 and 40.50, we should see the 4, and then the 5 goes. That would be kind of the expected scenario, something like that. If we don't get any move down, at least down here to the 23.6 level, then I would say the 3 leg is still forming. So if the market continues higher next week, and we keep doing like this, then we haven't had a correction yet. We're still in the 3 leg, and we're still moving higher. So that's what we're looking at right now. If you're a subscriber to the site and you're following along with the alerts, we moved to 50C, 50G, like back in here somewhere, in anticipation of this correction. So if we get, at some point, if this is not the 3, we'll get back in more into the stock funds, but we have to see how this plays out. Okay. So the retracement levels to look at 42.33 and about 40.50. All right. So this S&P composite cycle. This is pretty interesting. I pulled this chart off of allstarcharts.com. JC Peretz, we talk about him all the time. He put together this composite chart. It's a little bit different than the one we looked at a couple of weeks ago. But what we're looking at is the blue line is a composite, so an average of every year between 1950 and 2020, every post-year election, so the first year of a new president, and every year ending in 1. Okay? So you get 3 big data groups, and you compile it all together, and you get that blue line. So historically, and it fits with all the memes basically, right? If you go away in May, and you come back after Labor Day, right, you're missing this. It's basically sideways, but you're missing all this chop. You come back after Labor Day, and historically you do great. So we've done this before in other shows, but basically from January to May, the market goes up. From October to December, the market goes up. And in the middle, the market goes choppy to down. So if you just played the seasonal long-term trend and you stayed in the market from January to May, got out of the market in May and got back into it beginning of October, you'd do really well. In 2021, how did that play out? If you had gotten out in May, you would have missed a huge move on the C fund. So, where are we right now? So I put in, this chart came out last weekend. So this week we had Monday's move down, and then Wednesday, Thursday, Friday's move back up. So that's what the black lines are. I added them in, and it brings us to where we are on that green dotted line, which historically is the beginning, the exact beginning of when the market should start moving higher. Doesn't mean it's necessarily going to happen. We definitely moved higher when the market should have been moving sideways to down. So could we get some more decline here and then pick it back up? Absolutely. At some point, I mean, so I'm looking at this with sort of a bullish bias at this point, because I know that historically, either this is the bottom or we get another move down to the bottom, but we should move higher from that. And it's also consistent with the Elliott wave count. So I'm definitely not saying that the market topped out here. We could still have some correction, certainly, but I don't think we've seen the top of the market for 2021. Okay. Bonus chart is the F fund.
That's an interesting bonus chart.
It is. I was going to do Palantir because I bought some Palantir stock on Tuesday.
Yeah.
But the F fund has some really good, it's specific to TSP, and it's got some really good patterns in here that I want to kind of talk about.
Learning stuff.
Yeah. It's an example, and it's a really good example right now. So basically two or three things I want to talk about in this chart. That idea of alternation that we talked about, that we might be expecting here on the C fund chart. We have it in the F fund chart. We got 1, ABC for 2. So basically a flat sideways 2. Then we had the 3 run, and then we had a sharp short 4. That came down and got support at the 50-day moving average line. Okay, so we had this flat sideways, and then a sharp 4. That's what we're kind of looking to have happen on the C fund in a longer term. The second thing is this idea of a truncated fifth wave. You don't see it very often, but ordinarily from a 4, you get some kind of 5 that goes higher than the 3. But it doesn't always happen. It doesn't have to happen. There's no rule that says 5 has to be higher than 3. So they call this a truncated 5. And I was sort of anticipating it, which is why for the past couple of weeks, and I've had a few questions about it, if you're not in the stock funds, why you're not in the F fund. Because the F fund chart setup was not looking good. We kept getting support at the 50-day moving average line here, but it was developing this like ascending triangle. And it broke to the downside, which it should have. That's kind of how it works. The pattern setup wasn't good, and that's why I didn't reallocate it all to the F fund when we did get out of the stock funds a little bit a few weeks ago. A 5 leg should be a 1, 2, 3, 4, 5 for a 5 leg, and we weren't seeing price move like that at all. It was this, we had higher lows and barely higher highs. It's just not the way that a 5th leg should play out. So that's kind of that. Alternation, this one and this one, and the truncated 5 leg. 2 big takeaways from the patterns in the F fund right now. You also got the indicators, all the technical indicators rolling lower. So in terms of the F fund, again, 2 days doesn't really make a trend, but if we have a low below this low right here, then we have a problem because we have this high, a lower high, and then if we have a lower low, now we have a downtrend in the F fund. And you're going to see it because if interest rates go up, the price of the F fund goes down. Okay. So we take a look at the 20-month weekly charts. We've been talking about this here for months. Every time the 10-week moving average line is the blue line. It corresponds roughly with the 50-day moving average line. Every time we hit the 50-day moving average line, 10-week moving average line, whatever, we've gone higher throughout 2021. This week was a little bit different. Can zoom in here. This week, we spent most of the week below the 10-week moving average line, and we closed right on it on Friday. So it was a good reversal. That's a bullish candle, so we had a great reversal. But I'm not satisfied that we're above that 10-week moving average line to get all back into the stock funds. So if we get resistance here, we could definitely come back down. If we get some resistance at that 10-week moving average line, we could definitely start coming back down. So the bottom line is we have to let it play out and see what happens. Okay. Having some problems with my pen functioning here.
Is it the pen or is it the user?
You know what it is? I didn't reboot the computer before I...
Oh.
Yep.
Gotta always reboot, man.
So I can't get rid of that red line, but coincidentally, it's probably going to set us up in all these charts. The S fund here we're looking at, again, it's back into its sideways consolidation pattern here, and unless it hit resistance at a bullish candle week, but hit resistance at its 10-week moving average line. And we got slow stochastic is not looking good. MACD has been on a decline since the top back here in February. So S fund is back in its sideways pattern. There's not too much to talk about there. I fund, same kind of thing. It was a down week for the I fund, but basically the chart is the same as the S fund. Came down, ran back up to that 10-week moving average line, and stopped right at it. We got some pretty big down volume the last couple of weeks, and we definitely have the indicators starting to roll over on the I fund on a weekly basis. So we'll have to see how it plays out. If the I fund turns back around and gets support above its 10-week moving average line, great. If it rolls over and gets below this low, now we got a pretty serious problem. F fund on a weekly basis looks a little bit different than the daily chart that we looked at as the bonus chart, but same kind of thing as the stock funds. Ran up, hit resistance at its 10-week moving average line, and didn't close. This is a bearish candle, so the difference between this one and the stock fund charts are, in the stock funds, it was white inside the candle. It means it finished at the top of the candle range. Of a red candle, red on the inside of it, means it finished at the bottom of the candle range. So the F fund ran up, hit its 10-week moving average this week, and then declined into Friday. Okay. So also indicators definitely starting to roll over. Okay.
Questions. We kind of powered through that.
Kind of did.
I thought we were going to have a lot of stuff to talk about. I stayed quiet.
Yeah, I mean, there's a lot to talk about. It's just that it's all on a day trading sort of mentality, and I didn't want to get into all that.
Yeah.
It's just not. It's not worth it. I mean, we had we had one big down day. It gapped. I mean, you could say the C fund gapped down on Monday, and it ran back up, filled the gap. It didn't roll back down, so that could indicate a strong market and a time to get back in. I mean, there's all kinds of ways to do this. It's just that within the TSP rules, there's only
it's not really worth it.
You can't do it.
Yeah, and it's not worth stressing about.
No.
You know, definitely. It's going to be, you know, we talk about this a lot. It's going to be interesting to see people's reaction when we do get that final kind of, not final, but like that correction we see coming, you know.
Yeah.
And you know, we've been talking about it for a while. So if anybody's surprised when it happens, you haven't been listening.
Right. So actually to that, whatever correction we have going on right now, and we still might have another week or two of, because seasonally we could still have some corrective price patterns going forward. But I really don't think that we've seen the top in 2021. So I think we have another leg higher, and when we top out on that leg, then that's the time that you really need to. Your buy and hold is going to be tested seriously when that happens. Let's put it that way.
All right. On that note, if you guys enjoyed the show, please share it with your friends. Hit the like button, the subscribe button, do all the buttons. Whatever.
All the buttons.
Tweet it, TikTok it, or whatever. I don't think we can TikTok
all those
it.
Things.
Yeah. Thank you guys for watching the show. We enjoy it, and we will see you next week. This will be a good week to be watching the.
Well, we got the debt ceiling and it's going to be a busy week.
It's going to be busy. All right, guys. Hope your weekend went well, and your week is going good after that.